Hey there, quick question. Have you ever felt that no matter how much you know about managing money, there's always something you didn't see coming? Like how that one stock that you were sure about and how it always seems that that investment seems to drop when you at least expect it?
That's the thing about money. Just when you think you've got it all figured out, something comes along to challenge your way of life. But that's what we're here for. In the first part of the series, we dove deep into some eye-opening lessons we've learned from years of managing money. Today, we're bringing you the next 10 though. And trust me when I say this, these are the ones that can really change how you approach your finances.
Whether you're trying to navigate risk, avoid overthinking, or figure out the difference between being rich and wealthy, these lessons will not only help you avoid costly mistakes, but also give you the practical strategies to make smarter choices.
If you stick with us through the whole episode, you'll get insights most people learn the hard way. Things like how to make your portfolio work for you instead of against you, why emotional intelligence is more valuable than IQ, and why simplicity wins at the end of the day.
By the time you finish, you'll have a clearer sense of how not just to survive the ups and downs, but thrive in your financial journey. And who doesn't want that?
So grab a cup of coffee, sit back, and let's dive into the next 10 lessons that will help you level up your money game.
Dominic, another historic two-part podcast. For our viewers, if you didn't watch last Monday's, you don't have to stop the video right now. You can watch these 10 and then go back later, watch the first 10 of the 20 money lessons that myself and Dominic, but mainly myself, honestly, have learned after managing money for the past 10 years. So we already covered the first 10. Let's cover the next 10. Dominic, do you want to get right into it? Do you have any, how was your weekend, man?
Yeah, my weekend was good, man. It was good. Just and good is obviously relative. My weekend, we cleaned up the backyard a little bit better. The front yard's looking like a brand new home. The house is getting just absolutely renovated. And I have a win of the week that I'm going to save till Friday. But I'm already, it was a Sunday project, so I'm going to save it for Friday. But I do have a good win of the week for Friday's pod. But just put it in the back burner, put it in my back pocket for later. But the week was good. How was your week?
My week was awesome, and that's pretty cool that you already have your win of the week so early on in the week. I don't know. Some people say that the week starts on Monday. Some people say it starts on Sunday. I'll give it to you and say it starts on Sunday. So you're good to go. You can use that on Friday when we come back. So last time on the first part of this 20 things we've learned over the past 10 years, we ended on part 10. So we're going to move on to number 11. And the group that was in was client relations and communication. So what I found after working with so many people over the past 10 years managing money is that number 11, rich people hate paying taxes more than they like making money.
Yeah, we all hate paying taxes, but I guess for them, they hate it even more. Why do you think that is? Is it because they see their tax money going to waste, maybe, or they're paying so much of it? What do you think that is? What's the background behind that?
I would say yes and yes. So I think a lot of it is because they're higher marginal tax brackets. So the more money they make, the more it seems to be evaporated just because of the way our tax system works. But also, I would say that if you're somebody who is in that higher tax bracket, you believe that, like, I don't need the government. I don't need anything. Like, I don't want any of that stuff. I just want to keep my money because I'm an island all my own, where other people might not view that. But what I've been noticing more and more is that not just the rich, but also just individuals kind of in any socioeconomic class are becoming more and more, what's a good word for it? They're looking, I guess, for ways to minimize their tax burdens, even if it doesn't make sense. I've had people tell me like, oh, I don't want to go and work an extra shift because I don't have to pay more taxes. It's like, yeah, I understand that. Like your tax bracket might be higher because you're making more money. But like, first off, I don't think you understand how tax brackets work. And second off, like you're still making more money.
That's really petty. That's so petty.
It's kind of like this. Like I just made $100 and like I can go and make $100 and then, yeah, I have to pay $20 to taxes and bring home 80. Or I can just say like, I'm not going to make any money because I don't want to pay $20 in taxes.
It makes no sense. it makes zero sense. So you're saying from a decade of learning, from a decade of, handling money, managing money, one of the main things you've learned is that rich people hate to pay taxes. They're just like us. They're humans. They're just like us. That's awesome. That's good to hear. So what can we learn from that?
You know what I think we can learn from it is that what's that old saying? The only two things that are guaranteed in life are death and taxes. Yeah. So what I've seen a lot is wealthy individuals and a lot of marketing companies for like financial advisors or financial products, as it were. And remember the difference between a product, a plan, and a portfolio. If you don't know what I'm talking about, go back to the first video. You can always watch that. We explain it there. But I find a lot of wealthy individuals are looking for investment products that will often have tax advantages, or they'll seek out tax efficient investments to minimize their tax burden. But when you really dive deep into the nitty gritty of those investments, oftentimes, not always, but oftentimes, those investments are going to return not superior returns to the investor, but hey, at least their tax burden's lowered.
Mm-hmm, mm-hmm. Yeah. Do you think people spend too much time worrying about lowering their taxes versus making more money?
Yes.
Yeah, because you can always make more money, but you can't really. There's a limit to how much you can be taxed, and that limit seems to be going up every year. But yeah, okay. So focus less. The lesson from this one is focus less on taxes, focus more on making more money. Right? I've yet to meet a guy who likes paying taxes, to be honest.
Yeah, and I can't blame them. I don't like paying taxes. No one likes paying taxes. But the amount of time that I have found people who, rather than focusing their time and energy on making more money to get themselves out of whatever scenario they find themselves in that they don't like, they focus more on like, oh, I don't want to make more money because I make more money, I have to pay more taxes. It's like, yeah, I get that. That is part of the deal. But also, you make more money. So all that time and energy and bitching and complaining that you're putting into having to pay more to Uncle Sam, why don't you just put that time, energy, and focus into making more money?
Mm-hmm.
That'll often fix the situation. So when I meet rich people that have this aversion to taxes, I get it. Like they don't have to work. So of course, the less they pay in taxes, the bigger focus it's going to be for them. But for the everyday, mom and pop, average Joe or Jane, I don't think that they should be focusing solely on taxes at the expense of focusing on how to make more money, how to spend less money. Control what you can control. You can always get a good CPA, but for majority of the tax things that people see on TikTok and all of these fun, like cool tax hacks, majority of them are for business owners. So you as a W-2 employee really can't do anything about that anyways.
No, that's true. Unless you want to start a business and go down that route. But yeah, that makes sense. So that was point number. Go for it.
And even if you do start a business for that to like do tax write-offs, like tax write-offs doesn't mean it's free money. I think so many people think it's that way. So for an example, if you're watching on YouTube and if you're listening, if not, my office, the place that we record this podcast and everything like that, this is all a tax write-off for me. But that does not mean that I get to recoup the cost of having this office in my home. It just means that if I made $100, say in the year, be a terrible year, but say I only made $100 and 20 of that $100 went towards maintaining the house, maintaining the business. That means I get to tell Uncle Sam that I only made $80. So if my marginal tax bracket is, let's say 20%, that means I'm really only saving myself $5.
Yeah. That's not great. When you could dedicate more of your time to actually making more money. Mm-hmm. Okay. So that's point number 11 of our 20 parts, correct?
Yep.
Let's get on to the next one. I'm excited.
The next one's going to be number 12, and that's actually going to move us into group number 4. And these are insights on wealth and success that I've seen from managing people's money for the past 10 years. Number 12, getting rich overnight is a curse, not a blessing.
Interesting. So you're kind of destroying a lot of those dreams for a lot of people. They want to hit the lottery. That's their saving grace. That's what they want. You're saying it's kind of a nightmare. I know for me, I've thought about hitting the lottery. That would be great, but I'd probably feel empty inside, right? I heard this thing from an entrepreneur I have high respect for, Alex Hormozy. Mm-hmm. And he said he was with his buddy once, and his buddy went to the gas station, fill up, grab some snacks. He went in with him. He's like, I'm going to get a lottery ticket. He's like, you want one too? And he's like, yeah, sure. And he got a lottery ticket and his buddy got a lottery ticket. And he said for the 24 hours that the drawing was going on, he was the nervous he was the most nervous he's ever been. It's like, why? Why is that? It's like, because in his mind, if he would have won, everything he would have done after that would have been, oh, well, it's because you won the lottery. It's because you got handed all this money. That's why you were successful. And he didn't want that. And I think that's so interesting because so many people, when they get the money, they blow it. They ruin their lives. A lot of people say that it's the worst thing that's ever happened to them. And you're saying that getting rich overnight is a curse.
Yeah.
Now, is there a kind of a threshold to where it becomes a curse? Like, let's say you know, I started a new business. Business was great. I made $20,000 this month, right? Curse or no curse?
I know you hate this answer, but it depends. And
I
the
do
reason
hate
that
that
it
one.
really depends is that what I found is that people that build their wealth. So like you just said in your example, I start a business and I work, and like I'm imagining that you're working hard to start a business, because no one just starts a business, not really trying and then makes $20,000. Like, yeah, that makes for a great TikTok. It makes for a great blog, but that's just not the way that the world really works. Sometimes it happens, yes, but you're looking at the one time that it happened out of the millions of other times that failed to happen. So people that work to make money tend to manage their money better than those who just acquire money quickly. So is there a magic number? No, it depends on the person. But people that work for their money and get rich over time, they've tended to build up the good habits, the good systems, the good processes, that when they have that money, they can maintain it. Versus someone who has never learned any of those systems, processes, money, beliefs, thoughts, habits, any of those things. And now they just are dropped a lump sum of money. And to you or I, like someone getting, I don't know, $100 that's not a lot of money. It's like, okay, that's $100. But imagine if you gave $100 to like a 5-year-old, and now they're going to go blow it on candy and stuff. It's the same exact thing when you're going to go and give like a few $1,000,000 to someone who has never maintained money when they're used to just living basically paycheck to paycheck.
Yeah. 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 That can be a very scary place to be. So really getting rich overnight, it's not something you should hope for. It's not something you should build for. You should build for long-term wealth is basically what you're saying. That's what I'm kind of learning from that.
Yeah, because, and even if you're like the getting rich overnight type thing, like that's all going to be hope. And we always say that hope is not a strategy. An example might be that a lottery winner may struggle to manage their newfound wealth, which is going to lead to poor financial decisions and most likely and most often an eventual bankruptcy. While
Yep.
people who've built wealth gradually learn to manage it wisely, so that when they actually have all that wealth, they're not doing stupid stuff on the weekends to try to get rid of all of it.
Gotcha. So you're going to want to really build a foundation and a strategy around the long term and the short term, not looking for, well, I need a gamble. I need a Hail Mary. I need that bottom of the ninth, bases loaded. I need this to hit. Like, no. That's a terrible strategy, is what you're saying, right?
That's not even a strategy.
No. That's that. Okay, well, you're blowing up my whole plan here. Alrighty. So you're saying I shouldn't go to the casino and bet my paycheck and double it. Is that what you're saying?
Well, I mean, if you can guarantee it and then, just double it a few more times, give me half of that, and we have a pretty good business venture, I think.
Indeed we do. Okay, so that's number 12. Getting rich overnight, it's a curse. Work towards the long term, build towards the long term. I like it.
Number 13. There is a big difference between being rich and being wealthy.
That's disappointing. I was just trying to get rich. Well, what's this other word? Wealthy? What do you mean? What are we talking about here, Chris? Fill me in.
So, wealth encompasses more than just your financial assets. It includes relationships, contentment, feeling joyful in your life. How do you feel about yourself when you're by yourself? I would say that is true wealth. And I've always kind of said it this way. Being rich means that you have a big paycheck. Being wealthy means that you have control of your time. That's just for me. Everyone's a little bit different.
That's a good one. That's the one that kind of makes me stop and think. Being rich is having a big paycheck. Being wealthy is having control over your time. Yeah, it's kind of interesting. I recently, this year, I switched from being my own boss to having a boss. And looking back on it, it's like, I never felt poor until I got a job. Which is so weird because I'm making so much more money than I was before. And it's like, damn, that is a weird place to be, to make more money and feel more poor. But at the end of the day, it's like, okay, well, good. That's good. It's being introspective and knowing that, okay, well, looks like I do value my time quite a bit. I do value my own decision making. This is my life, and I would like to be in control, at least somewhat, or have the illusion of control over it. And that's a whole nother podcast in itself, for sure. The illusion of control, and choice. Interesting. Okay. I heard this thing. I'm gonna go off on little tangents here and there just because I find it interesting. And on the topic of control and the illusion of choice, I was listening to this famous drop shipper. You don't know what that is. That's a person who buys a product from, let's say, China, sells it to, we'll say, America at a much higher rate, right? They make the product look fancy, right? So he would run Facebook ads, and let's say it's $100, right? And in the comments section, he would go in there under a different account and be like, I found it cheaper at this link, right? And it would go to this link and it would show on Google the same product, 5 different times, 5 different prices, and people would choose the cheapest one, right? It makes sense. But it was the illusion of choice because he owned all 5 of them. And I think that's so interesting. So that's choice for you right there, the illusion of it. But getting back to it,
before we get back to it, I'm gonna stick on your tangent just for a little bit more. Have you ever noticed when you go out and you see vending machines, like you see a Coca-Cola vending machine, right next to that, there's going to be a Pepsi vending machine or a different one. You ever notice that?
Yeah.
Do you know the reason why they always cluster together?
Tell me, what do you got?
So if there was just an individual one, a single Coke machine or a single Pepsi machine, the question in your mind is automatically, do I buy a Coke or not? When there's a Coke machine and a Pepsi machine next to each other, the question in your mind automatically goes, do I buy a Coke or a Pepsi? So regardless of what happens, the reason they stick together is because one of them is going to win versus neither one of them winning. It's the same reason that Lowe's and Home Depot are in the same exact area as every single city. It's because you're trying to make that choice. Do I prefer Lowe's or Home Depot? They don't care who you go to. I mean, of course they care. They care a lot, but they know that you're now choosing, am I going to go to Home Depot or Lowe's rather than I just going to go to Amazon?
What? Oh my gosh. That's crazy. I never thought about that. You know, it kind of reminds me of one time I saw a vending machine, and it was just one vending machine. It was like on the side of the road, and I was like, that is so suspicious. But when you see like a few of them, it's like, oh, it's meant to be there. That is so weird. And should I get a Coke or not? Or should I get a Coke or Pepsi? That is diabolical. Oh my gosh, that's crazy. Clip it, put it in a short, clip it. That's crazy. Okay, back to business. Back to the part 2 of the 20 lessons you learned from managing money for a whole decade. What do we got?
Yeah, so we're going to go back to number 13 about being rich versus wealthy. But a person who has a high income, and I've worked with individuals who have very high incomes, you know, $300, $400, $500,000 and upwards, and they still somehow manage to live paycheck to paycheck. And just because they're making $500,000 a year, most people would look at that and be like, wow, look how much money they're spending. They must be super wealthy. But I would look at that as their financial advisor, actually knowing behind the scenes to be like, no, they're rich, but they're living paycheck to paycheck. And the guy who I'm managing their money for, who's only making $40,000 or $60,000, but is living in a 1-story apartment or like living inside of a 1-bedroom apartment, is happy with what he has, gets to go home to his wife and kids every night and is happy. And they're saving more money. They have more investments. While yes, it is less than what the rich person can make the rich person could probably make this person's investments and savings in one paycheck or in 1 year. But also the rich person has a spending habit that is, where they're making $500,000 is worth $600,000 of spending, where the person who's making $40,000 is spending $20,000. And of course, these are random numbers that I'm just throwing off the top of my head, but there is a huge difference between rich and wealthy.
Interesting. I like that one. So understanding the definition of rich and wealthy and finding out which one you want to become is super important. I know a lot of people are focused on money, but money was never the goal for us. All right, we're trying to be free. Financial independence. 5. Right? Little ding right there, possibly. Keyword trigger. But I like that. I like that. Rich is having a big paycheck. Wealthy is having control over your time. I love that.
And I think a lot of people, they confuse the two things, right? We always say, like, there are a lot of people that look at wealthy people and be like, oh, I don't like that person. But if I had that money, I would be a good person. And we all have this little, it's a cognitive bias they all have in our head. Rich people must be good people because they are wealthy. And now we've kind of perverted it here in our culture to say rich people are bad people because they're wealthy. And now we've also like take it to another like weird cognitive bias step to say like, but if I had the money, I wouldn't be like that. It's kind of like when you see someone driving a really nice car. No one has ever seen someone driving a really nice car and be like, that guy is super cool. What you always think is that guy's probably a D-bag with a tiny wiener. But if I had that car, I would be super cool and everyone would think that I was super cool.
Yeah, honestly, I don't even think about the driver. I'm just like, man, how did they get that? How did they do it? I mean, like, it's possible. Like, I saw a blacked out Cybertruck today, and I was like, first of all, that is gnarly. It's so cool. A lot of hate. Chris probably hates. Chris, you hate it?
Oh, I see the Cybertruck around here. It's pretty cool.
It's pretty cool. Okay, there we go.
The matte black one. Yeah, I've seen it.
Sick. Okay, so very cool, very cool. So yeah, we definitely want our control of our time. And like a few podcasts back, Clint Harris said, it's all about time freedom, location freedom, and money freedom. Obviously, that would be the first one. Obviously, it's a finance channel. That it is. But that's for him, right? For you, it might be different. For me, it might be different. And that's totally fine. But we got to have a goal of what we're shooting for if we want to truly be wealthy and truly be free in this life.
You have to know what enough is, which is the hardest question in the world. What is enough? And maybe one day we'll do a podcast on trying to ask that question and go down the rabbit hole, because in truth, there really isn't an answer. No. But who knows? Maybe one day we'll explore it.
Yeah, there's got to be a ChatGPT mathematical equation that we can apply to our life to bring value to it, to bring it to light. I don't know. Maybe. We'll see. Alrighty. Number 14?
Number 14. This is something that has taken me a very long time to learn, and I still struggle with it every single day. And so do many clients, unfortunately. Number 14 is optimism should be your default. Optimism should be your default setting in life. What I mean by that is having a positive outlook is critical in not only investing, but also in life. And optimism tends to lead to success. Because whether you think you can or whether you think you can't, optimism versus pessimism, you're right.
Yeah.
There's the person who has a pessimistic attitude saying, why even try investing my money into the stock market? Why even try going after that job? Why even try learning that new skill? It's not going to work out. You're exactly right. It's not going to work out because you're never going to put in the time commitment to actually do it. Where the person who's an eternal optimist is like, you know what? I may not know how to do that, but I'm sure if I try really hard, I can figure it out and I can be successful just like other people. Optimism should be your default.
And that's so easy to say too. That's so easy to say. But my belief is the quickest way to transform your mind to an optimism default is to have perspective on how good things really are. I know for me, in how I was raised in my childhood, one of my parents was a deputy sheriff, my mom, right? So every night she came home, that was a great thing, right? Every night she got back to the house safely and alive, that was a win, right? So what's the opposite of that? She gets killed, right? That's the perspective on which I dealt with as a child, right? So when you might be like, Tom, you're always optimistic. It's like, dude, yeah. My mom came home today. My dad came home today. They're alive. They're both alive. Like, there was a chance that they might not have made it, and they won, right? That's how can you be sad when, like, dude, that's a lottery. Forget the lottery. That's my lottery. That's my victory. That's my wealthy. That's a win. So for me, that's where the perspective shift happened, and that's why I'm more of an optimistic person than a pessimistic person. And it's like Chris said, I mean, it changes your whole life. I guarantee you'll probably live longer, and you're definitely going to live a happier life if you're more of an optimistic person. I'm not saying cynicism is a bad thing. We need it every now and again. It's great to question things. It's great to question how things are done, why they're done. I'm all for questioning things, but you can be optimistic and question things without being so cynical and thinking the worst of everybody all the time.
Please don't think just because I put this as one of the lessons that means that I am perfect at it. In fact, the reason that I have to put this as a lesson is because I am naturally extremely cynical. Just like you, Dominic, every day that mom and dad would come home, like it was a win. I had the exact same thing. When my dad especially would deploy on military campaigns, mostly to Iraq and everything like that, every time that you got a phone call, every time that you got a knock at the door, that was the biggest fears, because you don't know on the other edge of that call, what are they going to say? a knock at the door, 2 knocks was the scariest freaking thing. And like, I still have triggers to like knocking on my door, just because the worst thing you do is open that door and have someone standing there with a flag. Like it. And for you and me, you came on to like, oh, my mom came home like, how good, I'm an optimist. But for me, I actually took it the opposite way of like, the world is a scary place and like, it is all bad. So I have to remind myself that optimism is the thing that we do this. The reason we invest for the long term is because we believe that tomorrow will be better than it is today. If you don't believe that, then there's no reason you should be inside the market. You shouldn't be doing anything. You should be stockpiling guns and cans of food and a bunker. Yeah. You shouldn't be trying to make money. You shouldn't be listening to this podcast. So what I found with working with people is that investors who maintain a positive outlook, especially during times of market turbulence, like a severe market downturn, and they believe in the long-term recovery of the market because of their optimism, helps them stick to their investment strategy, which ultimately leads them to success in the long term.
Beautiful. Beautiful. Yeah. You talking about the knock on the door and the phone call ring? Dude, that brought me back. That brought me back. Like I could break down right now if we went any deeper. And that's crazy, right? That's insane. But life is beautiful. It's beautiful, and it deserves to be cherished. It deserves to be enjoyed. And part of getting to that enjoyment is getting to that financial freedom, that independence, that number. Like we talked about earlier, what's your number? When is enough enough? Because for most people, enough is never enough. And I don't know how to change that. And that's scary. Because we're I hate to say it, but we're greedy. People are very greedy. And we're scared. We're scared of running out. And it's tough when it's rational. It's a rational fear. Nobody wants to be 80 and broke, 60 and broke, 70 and broke. Nobody wants that. But how do we cross that line? How do we build a life where we don't have to be in fear? That's what we're trying to achieve with this podcast, is teaching and learning how to get to the end and live a beautiful life along the way in regards to finance, taking care of your family, and taking care of yourself.
Beautiful sentiment. And if you're getting value thus far, please like, subscribe, leave a comment for the algorithm. We love you thus far. And if you found one that has really resonated with you thus far, please let us know which one of the 10 in this podcast is your favorite lesson that we've learned over the past 10 years. So I'd like to move on to grouping number 5. And this is our final grouping. It has the last 5 of our 10 that we're going to be discussing this time. So number 15, biggest risks are always the same, yet different. I'll say that again because I know it's a little confusing, but the biggest risks you take in life and in investments are always the same, yet they're different. So market environments might change, but the common mistakes always persist. Timing the market, recency bias, emotional reaction over market trends.
Interesting. Could you give us an example of how they're different a little bit more, like on the personal side, right? When it comes to like big risks, and could you go a little bit deeper on that? I'm right there. I'm right at the edge of understanding it. I just want a little bit more.
Yeah. So like I was saying, the biggest risk is always the same, yet every time it's different. So the trigger, the black swan event, the thing that causes people to lose their shirts, as it were, is always the exact same thing. It's always driven by fear and greed. Those are the common things every single time. What triggers that fear and greed cycle to finally end is always a different thing. Maybe it's 2008. Maybe it's Y2K. Maybe it's COVID. All completely different triggers that all started because of the two things that most human beings, or all human beings, are guilty of, which is fear and greed. So when people were during the 2008 bubble and everyone was trying to buy up real estate with, people who worked minimum wage jobs were buying their second or fourth home. And eventually the market tanked. And who would have seen the day that we woke up that Lehman Brothers went under, and then everyone realized this whole banking system is all just a bunch of funny money and none of it makes sense? Who would have seen that happening? It was the exact same thing that happens every single time. Fear and greed. It was just a different trigger. During COVID, who would have seen that for years and years that the government was just printing a bunch of money, and everyone was just going out and spending on their credit cards, pretending like the sky's never going to fall, pretending like, because of the recency bias of things are good right now, therefore they will persist to be good indefinitely into the future until the day that we find out that there is some new sickness coming out of maybe China or somewhere else. And everyone goes, it's not that big of a deal. And then all of a sudden, everything shuts down. And again, the same system of fear and greed and recency bias of things are good will always be good was the same. The thing that was different this time is that there was disease that, while thankfully it didn't, very well could have really destroyed, our entire economic system. That's the reason that the federal government pumps so much money into the system. I'm not saying it's right. I'm not saying it's wrong. It is what happened. But the reason that they had to do all these things is because while the risks are always the same, they're also just a little different. The triggers are a little different.
100%. 100%. That is a very interesting point. It's a very interesting discovery. I'm kind of curious, was there certain events in your decade of managing money that really brought you to this conclusion? Or was it one moment, or is it just you're seeing a pattern repeat itself?
That's a great question. I would say a little bit of both. Over the 10 years, like I wish that I had the knowledge I have right now when I started. Shoot, I'm sure in 10 years, I'm going to look back and say, I wish I had the knowledge that I have in 10 years. But when I started out investing, I was very much a student of Warren Buffett and value investing. And I was always kind of taught that it's time in the market, not timing the market. But that was difficult for me to also try to figure out between, well, how is it timing the market and time in the market when we're value investing and we're keeping money hoarding in cash, ready to deploy when the market turns irrational? Those two statements are contradictory. If you want to have your money in the market all the time, but also you need to keep your money in cash in order to deploy into the market when the market is bad. So those two things I wasn't able to square in my mind. And I still have trouble with that. But what I found is that, not only me, but a lot of other investors that I've worked with in the past, they'll often fall traps to this market timing, and they believe that they can predict when to buy or sell. And that often leads to, and it's led to with me, huge missed opportunities and losses. One of my biggest regrets as investing is when I started making money. When I started making money, didn't know what I was doing. I put a bunch of money into my 401k. I think I put into a target date fund, and I never looked at it. And then, years and years later, I looked at that, and that balance had grown pretty substantially. And then I started getting down the rabbit hole of like, what is finance? How do you do this stuff? And then I started thinking, oh, I'm smarter than the market. So I took all that money and moved it to cash because I knew how to time stuff. And every single time that I thought that I was smarter than the market, which the market, it really is it's a hive brain of all people on earth, and a hive brain that is not rational, an irrational hive brain of all the people on earth. I thought that I was somehow smarter than that. In addition to that, not just this hive brain of irrational people, there are also algorithmic traders. There are supercomputers that are competing against you individually listening to this podcast, and me individually talking on this podcast. What makes me think that I can beat all of that?
I think that's the trouble with young men in America, is our arrogance, our logic, and the stock market. It's a culmination of all of our weaknesses, right? It's like, well, it can only go up or down, a 50-50 chance. Okay, why not? I'm smarter than everyone else, so I can beat the market. And money. Young men love money. They love money so much. They want to be a millionaire by 25 and drive the Lamborghini and show up to reunions. And it's like, come on. Like, what are we dealing with here? So yeah, a lot of people fall trap to the stock market. I'd be surprised if, I don't know what the percentage is, but it's got to be high. It's got to be high. And it's not a smart play. If you are smart, act smart. Don't pretend to be smart. Okay?
Yeah. I mean, you have to remember that only 3% of professional money managers beat the market.
3% of people who get paid lots of money to manage money beat the market. 3%.
And that's usually, just to clarify that 3% is on a 10-year timeline, but it's still 3%. Or rather than doing any of work, you just put it in there and you beat 97% of people just by putting money in there and not doing anything.
Yeah.
But that's not the way that we work, because we all have a bias towards fear and greed. And we all think we can time the market. We all have recency bias. We all have emotions that react to market trends.
Absolutely.
And with that, I want to move on to number 16 because it does tie into this.
Perfect. Let's do it.
Number 16. We already kind of talked about this a little bit, so we're going to state it again. But the market doesn't care how clever you are.
No, it does not. Oh, yeah. Money does not care about you one bit. It does not care at all. And you will get eaten alive if you think it does.
And the biggest thing I've learned from managing money myself is that effort does not guarantee investment success. Results matter more than complexity and strategy.
100%. 100%. And I think that's why a lot of smart people have so much trouble when it comes to the stock market. Because they've come from a world where it's like time in studying, time out A+. Time into the market studying, time out, you don't know what you're going to get. Right? Could be up, could be down. So that's a lot. That's hard for a lot of people to handle.
Yeah, because it's so illogical, right? It doesn't make sense. Like if you were the star football player, if you were an athlete, if you were the person that made it into the Ivy Leagues, you realize that like it's my hard work, my dedication, my time, my effort, my talent that sets me ahead of everyone else.
Yep.
And then you go ahead and you put your talent, your time, your effort, your intelligence into the stock market. And while you may even be right on the short term, or if you're right, but you're wrong on the timing, effectively you're wrong. And that's really hard for people to square because the market can remain irrational longer than you can remain solvent.
Exactly. Exactly. And it's also like you're playing a different game when in actuality you should be playing, rather than trying to get rich quick, you should be playing to stay in the game. That's really the game you should be playing, because getting wiped out is rather easy. Rather easy.
Yep. And I can speak from experience. You know, I've created complex trading strategies, you know, and I've learned them and I spent lots of money to be taught it that ultimately lost me money because the market was behaving unpredictably.
Yeah.
And no matter how smart I thought I was, no matter how much money I spent on knowledge, on the perfect trading platform, on all this stuff, none of it really mattered because even if I was right, or you know, maybe I had the right strategy, but I had the wrong timing, effectively you're wrong.
Yeah. The market doesn't care about your slow moving average or your VWAP or your RSI, you know, the volume. The market will do what the market will do. And it's just as random as anything else, right? On the short term, that is. On the short term. On the long term, it's a lot more predictable, but on the short term, it's like me when I don't eat. Very unpredictable, very hangry, basically. So that was number 16. The market doesn't care how clever you are. I like that one. That one's simple enough. Enough. You know, it's good to not put emotion on inanimate objects, right? It does not care, right? That's smart. So number 16, should we move on to number 17?
Yeah, let's go ahead and do it. And this one's going to seem a little confusing. So I'm going to say it and then I'm going to explain what I'm talking about. And then I'll say it again. So career risk explains most irrational decision when it comes to the investment business. I know that you don't know what that means. So I'm going to state exactly what I'm saying there. As someone who has worked as a money manager and have worked with other money managers, other people who professionally manage money for individuals, oftentimes career risk, someone having the propensity to maybe lose their job, lose their bonus, lose their status, explains most irrational decisions when it comes to the investment business. So when it comes to being a money manager, a fund manager, a hedge fund advisor, whatever you want to call yourself when it comes to money, incentives drive all things. So what I'm going to say is there's a lot of nonsense that goes on in the investment business. Clear as day. That's as someone who's worked here for a while, there's a lot of BS behind the scenes.
Mm-hmm.
And most of it, if not all of it, can be explained by simple incentives. And we've talked about this before, the difference between a broker dealer and a RIA, registered investment advisor, or it looked at the incentives. If I have investment option A and investment option B, and I'm a broker and I get paid a commission, and investment option A is a great investment and investment option B is a good investment too. Investment option A, maybe professionally, I think could be better for you, but investment option B pays me a bigger kickback. Look at the incentives. Everyone needs to eat. I'm going to give you investment option B. and majority of all investments, of all things, are dealt by this behavior. That's the reason that 97% of fund managers cannot beat the market, because rather than being able to make the short term or the long term decisions and focus on, yeah, right now it's probably going to hurt a little bit for us to maybe hold some more money in cash when the market's going up because everything seems irrational. If you do that, the incentives are every single person that's put money with you is saying, I'm not paying you to sit in cash. So they pull their money away. So the incentive is, I guess I have to be active all the time. I have to be buying and trading. I have to be doing a bunch of BS work because the incentives are aligned. My career is at risk, which is now leading to irrational decision making.
Yeah, that is true. That is true. And there's not really a way to tell. Is there? Or is there a way that you can find someone who will look out for your best interest?
It really comes down to trust. I wish I could tell you like, oh, just find a fiduciary, but even that's fraught. Like we've talked about people that are duly registered, it's really, really difficult. I think one of the best things you can do if you're really concerned about it is find someone who is fee only, not just fee based, fee only. So like you're paying them by the hour or by the service, not by the amount of money they're managing for you, not by the product they sell. It's only like, hey, you pay me, I don't know, $1,000 and like, I will review your entire financial plan and I'm getting paid by the hour. My incentive is now that. So that's how things can be a little bit different. But what I found is that a lot of like fund managers may make like short-term decisions that appears to investors or that appeals to their investors and protect their job, even though those decisions aren't best for the long term of the funds. You see that a lot with mutual funds, where mutual funds, like everyone's only looking for like which one got the 5-star rating last year, which one had the best returns last year. And the reason that it had great returns is because maybe those managers took risks that they shouldn't have. But those decisions that may have worked well in the short term are not going to work well in the long term.
Interesting.
Have I ever told you about Ford when they were a dividend aristocrat? So Ford Motor Company, they were a dividend aristocrat for a very long time. And what that means is that we were paying dividends for, I think it's something like 40 or 50 years. And you lose that aristocrat if you ever stop paying your dividend. And a lot of people like to dividend invest because they feel that it's free money. It's not, but that's the way they feel it is. So when Ford Motor Company was going through some pretty substantial business fluxes, rather than cutting their dividend, which they should have done, they went ahead and started taking out debt in order to continue to pay their dividend. So they were funding their dividend by paying money to their shareholders with debt. They were taking a short-term decision of let's just make money right now at the expense of future Ford company, which eventually led to a bankruptcy that they had to go through and restructure.
How interesting. So they didn't want to stop paying the dividend because it would hurt the stock?
Because people would say like, oh, they're no longer a dividend aristocrat because they stopped doing that. So something must be wrong with the company. And most people aren't going to read a 13F. They're not going to read any of that stuff. They're not going to look that deep. They're just going to see as the dividend coming in. And if that dividend gets cut and now it's on Bloomberg or it's on CNN and whatever that guy is, who Mad Money guy is sitting there saying sell,
yeah,
and freaking out, people are going to go like, oh, I don't want to do that. I must leave Ford. And then the share would plummet. And imagine if you're the CEO and the CEO's job is to keep the share price high. That's their only job. So their incentive is aligned to keeping the share prices high right now. And that's one of the big issues with CEOs that aren't founder-led. Founder-led CEOs often have a long-term perspective where they'll make maybe weird-ass decisions. Think of Mark Zuckerberg with Meta. We're going to just do all VR stuff. Everyone for 2-3 years thought that was the dumbest thing. And now with the advent of AI, everyone's like, okay, I get it. Like he was a visionary and he saw it through.
Yeah.
Would you think that had Mark Zuckerberg not been the founder, had he just been a CEO that was there for a year or two, that he would make that decision? Definitely not. Same with Jeff Bezos, same with Elon Musk.
That's so true. That's so true. Because the CEO is worried more about dollars and cents versus more the future of the company.
It's on the CEO, but someone that's founder-led, they're more focused on the vision, on what they want to bring into the world, rather than the dollars and the cents. Dollars and cents are important. Don't get me wrong. But if your goal is to get to Mars, You're not caring about what you do, what the share price is happening tomorrow.
I agree. I agree. I agree 100%. So that was number 17? 17.
Mm-hmm.
Gotcha. Career risk explains most irrational decisions in investment businesses. Gotcha. Okay. Interesting. That's it. Yeah, I can. The more you look at that one in the world of business, the more you can tell it's like, oh, I see where this applies.
Incentives drives all things. I don't think I'm very smart, honestly. I think the one thing that separates me from most people is that I am very big on asking myself, what does this person gain?
Mm-hmm.
What pro bene, like who benefits?
Yeah.
If I know the incentives, I can tell the outcome. And that's always hard because sometimes the incentives are skewed, if not completely hidden.
Yeah. And even when you find, oh, there's the incentive. Is that the whole incentive? Like, what are we looking at? You never know when you're 100% right. You kind of just have to guess. That's tough. So number 18, let's get on with it. Let's do it.
Number 18, and I promise this is not self-serving because I am young, but I have worked with a lot of people. Experience is not the same as expertise. So longevity in investment does not equate to being a good investor. Many experienced investors, in fact, repeat the same mistakes over and over and over again. Where someone who is younger, because maybe it worked for them for a long time, and then just because things changed, but they learned that this is the system that works.
Mm-hmm.
I couldn't imagine what it would be like had I started into the market and everything that I've tried all worked. Because then I would have thought like, I must be a genius.
Yeah.
I tried and I failed a bunch of different times where most people would be like, oh, the stock market is it for me? I just kept on thinking like, I just must not have something right. And I need to figure out what that is. So
yeah,
imagine.
Honestly, I feel like that's what happens with a lot of like people who are trying to sell you something, sell you a course or something. It's like, well, I got it right on my first time. Now I'm going to sell. And then like everything crashed. Now I'm going to sell you how I won, how I did it. It's like, that seems flawed. That seems very flawed. Yeah. Yeah. To win early is not good. It's better to learn how to lose than to learn how to win.
Yep. And, this is something I see a lot, especially as a young advisor, as a financial advisor who is tatted up. I'm not a white guy in his 60s, which is the average financial advisor. Working here in Arizona, especially with a lot of retirees, a lot of them will look at me and be like, "Oh, like you can't be a professional. Like you can't be a financial professional. You can't know what you're doing." Like, and I don't disagree with them because in their mind, a financial advisor, someone who's professional money manager, a professional at when it comes to how to think about money, how to interact with money, how to handle money, looks like this idea in their mind. And that idea of their mind looks nothing like me.
No, a jacked, handsome, dark complected
I don't know about
guy.
those.
I'm hitting all. Listen. If I'm anything,
I'll take the dark complected. Yes, that's true.
Handsome and jacked. That's what I know. Listen. I'm like Honest Abe out here. I can't tell a lie. Just trust me. When you get raised by a police officer, you can't lie. They know it. They know all the tricks, man. They know all the tricks. So it's better just to tell the truth. The truth never changes. Anyway. So experience is not the same as expertise. Gotcha. So you're telling me the third string quarterback that did 20 years in the NFL doesn't have the same knowledge as, say, a Super Bowl winning quarterback first string who's only been in for 5 years? Okay, that makes sense. We're shooting more for the expertise versus the experience. Because sometimes when you've been in the game a long time, you get complacent. You start to not challenge the status quo anymore. You start to sink into the patterns. Rather than being the force of change, you are just going with the waves. And for some people, that's what they want, but that's not really a good option, is it?
Yeah. And I can give a personal experience. When I first, started my own thing and I went on my own practice and, stopped working for somebody else, started working for myself, I went out and I sought mentors who had experience, who I thought, oh, they must be experts because they've been doing this for a long time. And I was very unlucky to only get like bad people, bad quote unquote mentors, bad experienced people. But from those people, I was able to learn so much, not from what they were supposed to teach me, but from what I saw them doing that I thought was wrong. And now for my firm that I work for, that Monzon Wealth hangs its hat at, as it were, I'm the youngest guy and I'm the chief growth officer. And there's a reason for that, is because experience is not the same as expertise. And not to say that I'm a financial expert. I never like to say I'm an expert at all. I'm a professional.
It's just important to know the difference, right? Just important to know the difference. I like that. I like that. So that was number 18. Experience is not the same as expertise. Moving on to one of our final ones. I'm kind of sad about this, but moving on to one of our final ones. Number 19. What do we got?
Number 19. And this is another one that's really hard for me to, say. And this is something that I struggle with a lot. That's the reason that it's on here. Being right all the time is overrated.
Tell it to my wife. I'm just kidding. I'm not married. But if I was, that would work perfectly. Being right all the time is overrated. Where did you learn this? Why do you think this? Tell me the reason behind it.
A lot of it was from watching those quote unquote mentors and from, years of learning and seeing it. But what I found is what you need to really focus on is making money rather than just trying to be right. And ego clouds all of your judgment. What I always like to say, and I've said it time and time before on this podcast, it is okay to be wrong. It is not okay to stay wrong. And too often do individuals who want to be, I want to beat the market. I want to be just smart, other financial advisors, other professionals, individuals on the street. They focus more on their ego and being right than actually, or they try to act right rather than be right.
Interesting. And what's the difference between acting right and being right? And to you?
The truth. So I would say that acting right is, hey, I bought I have a thesis on this stock on whatever it is, and it's going to go up or whatever. And then you make this a public declaration. You go ahead and you buy into the stock. Something changes in your thesis. Who knows? Maybe you buy into the stock and it goes down tomorrow because of just the way the market is. But you get new information. Oh, hey, maybe the company isn't doing what I thought, or they're misreporting something on their funds or something like that. But you made a public declaration and now your ego's tied up. And I said that I'm right. But even though the thesis has changed, you're sticking with it. And that's where I say that making money is more important than being right. It's okay to be wrong. It is not okay to stay wrong. Too many people are afraid to be, quote unquote, a flip-flopper. I said this before, and we've talked about all of the 25 cognitive biases that I know of. And that consistency bias is so difficult because when we were early hunter-gatherers on the savannah, the guy that shows up occasionally, the guy that and takes some food and then doesn't really help out, the guy that sometimes helps but sometimes doesn't help, that guy's getting kicked out of the tribe. So we all have this bias in us that we want to remain consistent. You see it constantly, especially in politics. Politics is one of the places you can see every single cognitive bias taken to the extreme.
Yeah. Yeah, you got that right. Okay. That's an exciting one. Being right all the time is overrated. And for our final point, do you want to move on to the final point?
Let's do it. The final point is the one that I wish I knew earlier and I feel is the most important. So I hope you guys hear this. The best portfolio is the one you can stick with, come hell or high water. What I mean by that is the best portfolio is not necessarily the most optimized, filled with silly formulas, spreadsheets, time, energy, commitment. The best portfolio is the one that you can stick with no matter what's going on in your life, no matter what's going on in the market, no matter what's going on in the world. I can speak from personal experience that I have created diversified portfolios that align with my risk tolerance, aligned with my goals, aligned with everything, but took too much time, too much commitment, too much work. And at the end of it, all it did was ended up leading me to burnout, and none of it was worth it. So sometimes finding a good portfolio that you just feel confident in, that's good for your risk tolerance, good for your goals, and then just allowing it and sticking with that course through whatever the market does, not panic selling, not trying to buy more. I mean, you want to buy more if you find a good opportunity. Maybe I shouldn't say that, but not panic selling, but whatever you can stick to I think there's an old quote that it's consistency beats strength. How did the Grand Canyon get formed? It wasn't because the river that came through was some crazy strong river. It was a pretty small river that just flowed for a really, really long time.
That's right. That's right. Consistency beats strength. And I like what you said about build a plan that you can stick with. I think too often, and this is going to be not just on finance, but everything. Too often do we make plans as humans that are, how do I get to I want to lose the most weight the fastest, the quickest path. I'm just going to stop eating. I'm just going to have one meal a day. I'm going to go on a walk. I'm going to go for a 3-4 mile walk every day. And I'm only going to have one meal. Like, okay, fine. That'd be a pretty big meal if you want to get your nutrients. Is it sustainable? And for how long? That's the problem. That's why I don't like diets. It's like, no, how about we just change who we are as a person? I'm not a person who eats garbage anymore. I'm a person who makes home cooked meals that are a little bit healthier, right? That's just who I am. I'm not someone who goes to the gym. I'm just a healthy person. I just happen to go to the gym, right? And I enjoy it.
You make it part of your identity.
Make it part of your identity. Exactly. And that's tough. That's difficult. And it's not an overnight thing. Or maybe it is. Maybe it is an overnight thing. I don't know. I think you can wake up and decide that, no, I'm going to be a healthy person from here on out and just be that. I don't think it takes 6 months. I think it takes 6 months to really transform yourself, maybe, but you can be that person today and just tomorrow be that same person, and the next day and the next day and the next day. And I like that. Build a portfolio that you can stick with. That makes sense. That's something that I can.
Be the person you want to be, and know that it's going to take time. It's the same thing with working out. I know we make this, this parallel very often, but you just can't go in there and be like, hey, I want to have a 6-pack tomorrow, especially if you're just some like normal dude.
Yeah.
And like what I'm going to do is I'm going to show up every single day. I'm going to be in the gym for 24 hours. I'm never going to relax, because again, that strength, like that commitment, is not going to beat consistency. You cannot put in so much work in the gym. It's just like brushing your teeth. If you leave the dentist on day 1 and then be like, all right, I don't have to brush my teeth again until 364 days from now. And on that day, I'm going to brush my teeth for straight 24 hours. And it's going to make up for the whole year that I didn't brush my teeth. Consistency is what matters.
Tell them. If you're going to take anything, take that one for sure. That's a good one. That's a really solid one. So that was number 20. That was the illustrious number 20. Do we have an action step for today's episode?
Of course, we have an action step. Here at the Five Guys, we are all about action steps. So to our audience members, please take a moment, reflect on your own financial journey, and write down one of the lessons that we discussed today that resonates with you most. And I want you to start to plan how to apply it to your investment strategy. Maybe you don't have an investment strategy. Let's start to create one so that we can start getting money out of the way, so we can focus on what matters most. So we can stop trying to be rich and start trying to work towards being wealthy. And just know that it's going to take time, and that's part of it. And that time is what's going to build you up, so that when you actually do have that wealth, when you are rich and wealthy, is what's going to stop you from blowing all of it. Because like we said earlier, the worst thing that can happen is you get a sudden windfall of money, because it never works out.
Absolutely. Well, with that being said, guys, if you're not already following the channel, I highly recommend to subscribe. Only people who want to be financially independent one day subscribe. So hopefully you're a part of that community. If that is true and you want to spread the word of finance and finally being free from the debt and the shackles of money and its control on your life, I highly recommend sharing it with a friend. It's so much better going on this journey with someone else, going with a friend, going and sharing this with someone who you believe deserves financial independence. With that being said, we'll be back on Friday for our normal podcast, our 5 Friday, with our recap of today's episode, our viewer mailbag, and win of the week. Very excited for all of that. Till then, hope you guys have an amazing week. I'm Dom, he's Chris, and we'll see you guys in the next one.
Later.
Peace.
This video podcast is sponsored by Monzon Wealth.
The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.